Hey guys, hamishwhodder here, and today we're going to be talking all about stocks and bonds. We're going to start off by talking about what is a bond and how is it different from a stock if you don't know what a bond is. Then I'm going to jump in and talk about how we value bonds. And the reason that I'm going to talk about that is because the way that we should approach valuing stocks, according to Warren Buffett, is exactly the same as the approach that we take when valuing a bond. Now, the maths in the middle of this video may be a little bit advanced for some of you, but make sure you stick around to the end, even if you don't follow the maths, because the theory that I'm going to talk about towards the end and what Warren Buffett suggests about valuing stocks is really important for investing. So make sure you stick around to the end. If you do enjoy the video, make sure you leave a like on the video. It helps me out a ton. And also let me know your thoughts down in the comment section below. But for now, guys, let's jump into it. So let's just start off by defining what a bond is, because I know that especially when I started investing, I didn't know what a bond was for a very long time. So what is a bond? A bond is a fixed income asset which represents a loan made by an investor to a borrower. So you can sort of think of a bond as being a transaction between a lender and a borrower, and the bond represents the contract that represents that transaction. So essentially the investor lends money to the borrower, and that money that he lends is called the principal. And then throughout the duration of the life of the bond, the lender is going to be making coupon payments, that's what they're called, coupons, to the investor throughout the life, depending on whatever coupon is attached to that bond. So if it's a 3% bond, then the coupon is going to be 3%. Then at the end of the life of the bond, which is called the maturity date, the principal is returned to the investor, and this is called the face value of the bond. Now, the reason that this is called a fixed income security is because the coupon payment, the payments that are received, the interest payments received by the investor are always the same. They're the exact same coupon at specific intervals throughout the life of the bond. Now, bonds can be issued by a range of different entities. Most commonly, we have corporate bonds, which is where a business issues bonds because they need to take on some money in order to fund some of their investments. And the other most common one is government bonds, and these are called treasury bonds. And these can be issued by any government. Today, we're going to be talking about US treasury bonds and Australian treasury bonds. And essentially, when we have government bonds that are from countries like Australia and the US, these bonds are considered risk-free. And the reason for that is because no government, or the US or the Australian government for that fact at least, have never defaulted on one of these bonds. So an investor has never given money to the government and received a bond, and then that investor has always made their money back. The governments have never failed to pay. And that is just not true about corporate bonds. A lot of corporate bonds, not a lot, but sometimes corporations sort of go insolvent. They can't make their payments and they go bankrupt. And for that reason, sometimes if you have a corporate bond, it won't pay. And for that reason, you'll notice that corporate bonds often offer a higher rate to make up for that higher risk. And in today's video, to keep things simple, we're just going to be talking about government bonds. So we're not going to worry about corporate bonds. We're just going to worry about the risk-free government bonds from either the US or the Australian government. So essentially, when it comes to treasury bonds, there is three major types. We have treasury bills, which is where you have a bond that has a maturity date of less than 12 months, so less than 1 year. Then we have treasury notes, which is where you have a maturity date of between 1 and 10 years. And then you have treasury bonds, which are bonds that have a maturity date of longer than 10 years. And then we have what are called coupon bonds and coupon-free bonds. So as I said earlier, some bonds offer a coupon, and that is how you receive your payments. You get a 3% coupon, and then every quarter or every year, you receive a payment in that form of that coupon. But some bonds don't have a coupon at all. And the way that you make a return is that you pay a smaller amount than you receive at the end of the life. So I'll explain what that means because that might be a little bit confusing. So let's first discuss what a coupon bond might be. So maybe you pay $100 in principal and you receive a bond with a 3% coupon attached. So that means that every year until the maturity date, you're going to receive 3% of your principal, which is 3% of 100, which is $3. And then at the end of the maturity date, you're going to get the $100 of face value back. That would be a coupon bond. So then instead you might have a coupon-free bond, which let's say, for example, you have a 1 year coupon-free bond. So there's no coupon. So what you do is you pay $95 for that bond, and then 1 year later you get 100 back. So you don't receive a coupon, you just pay less up front and you receive more at the end. And the difference between the two is about 5% in this example. So that means that you earned 5% on that bond. So then how do we calculate the value of a bond? And the maths formula is a little bit confusing, but the concept is simple. The value of a bond is simply the total amount of coupons that we receive over the life of the bond, plus the principal or the face value that we receive back at the end. So that's all it is. It's the value of all of the coupons, and then we're going to take those coupons and discount it at an appropriate rate. So I'll give you an example so that it might be a little bit easier for those who don't completely understand the maths. So you find a bond that pays a 3% coupon yearly for 5 years, at which time you will receive $100 in face value. Let's also assume that we want to make a 4% return, so our discount rate is 4%. Using the present value of a bond calculator linked in the description below, we come up with a present value of $95.55. So if we paid $100 for this bond, we would make a 3% return. And that's because we pay $100, we receive a 3% coupon every year, and then we get our $100 back. So the $100 at the start and the $100 at the end cancel out, and we just work out that the value is just the coupon payments throughout, which is 3% per year. However, if we paid $95.55 as we just worked out, then we will receive the 3% coupon, plus we'll make a little bit between the difference of the $95.55 that we paid and the $100 that we receive at the end, and the total of all of the coupons plus the difference in what we paid and what we received at the end means that we would make a return of a total return of 4%. So just a quick summary for those who didn't understand the maths. The value of a bond is simply how much money it brings into us. So it's the coupon payments. That's one of the ways we make money. We get coupon payments yearly. And the other way is that we get the principal back at the maturity date, or the face value back at the maturity date. Those two things are our cash inflows, and that equals the value of the bond. Now, I mentioned Warren Buffett at the start of the video, and the reason is that he always talks about stocks as if they are bonds. And I'll explain what I mean by that. So you know how we had the bonds, we had a coupon payment, and it was called fixed income because that coupon is the same payment every single quarter or year. And then we receive the maturity, we receive the principal back at maturity date at the end. Now a stock is exactly the same, except we don't know what we're gonna get back at the maturity date, and we don't know what the coupons are. Because the coupons are essentially how much cash is being returned to the owners by the company. And that's our job as an investor, to calculate what those coupon payments are, to calculate what we're going to be able to sell the business for in some future time. Maybe it's in 10 years, maybe it's in 20 years, or maybe we just don't include that and we just focus on the coupon payments. But this is exactly how Warren Buffett says to approach it. Just focus on how much cash a business can bring into you. Remember, I just said it before. The value of a bond is just how much cash we can receive from that bond. And just think of a stock the exact same way. How much cash is it going to give us? I did a video explaining how Warren Buffett calculates intrinsic value of a stock. And if you go and watch that video, I'll leave a card to it up there and I'll leave a link to it down in the description below. If you watch that video, you will notice that the mathematics in that is very, very similar to what I just showed you with the value of a bond. And the reason is because he values them both in the exact same way. Now let's just talk about risk and return for a little bit. So you might have wondered why bonds always offer a worse return than equities, or they usually do. And the simple reason is that government bonds especially, they're risk-free. There's no risk, so that means that they offer a low return because it's safe. The uncertainty of the cash flows of a business, so we know what the cash flows are going to be of a bond. We know what they are, but we don't know what the cash flows are going to be for a business or a stock. So that means that that uncertainty surrounding those future cash flows and how much money we can get from a business is why investors demand a higher return. A common misconception by investors is that risk and return are polar opposites. That if you want to make a high return, you need to take high risk, because there needs to be a high uncertainty of future cash flow. Or if you just want to make a low return, or if you want to take low risk, if you want to take low risk, you can only get a low return. Because if it's low risk, if there's low uncertainty about cash flows, then there can't possibly be a higher return. And this is true in some circumstances. As I just mentioned, if there is a higher risk, investors will demand a higher return. And generally speaking, when there's lower risk, investors will demand a lower return. However, this isn't always the case. And one prime example of this is the fluctuations in the market from pessimism of a recession to optimism of a bull market. When we go into a recession, there is going to be some businesses that are going to get really, really risky. The future of their cash flows is going to be very uncertain. And as a result, their stock prices are going to come down dramatically and the return is going to go up and the risk has gone up too. However, in a recession, almost all of the stocks on the market get pulled down with that. And for that reason, there are some stocks in that mix that haven't increased their risk, but the return has come up because the price has come down. So, for example, there would be companies where the cash flows of the business don't really change through a recession. They stay pretty stable. But if the price comes down for those future cash flows, so the price that the money you have to outlay in order to receive those cash inflows, if the price that you pay goes down, it just means that you've got a higher return. So during the very bottom of a recession, in the very depths of an economic downturn, you will often find that stocks that have very low risk offer a really, really good return. And this is exactly the type of business that Warren Buffett looks for when he's investing. He has the patience to wait for these opportunities to come along. He studies a business extensively for many, many years. He understands all the aspects of the business. And when we go into a recession and prices fall, he can look at those businesses and work out whether or not the fall in the price is justified or whether the risk has really not changed, but the price has just come down. And those are the opportunities that you want to exploit as a long-term investor. That's all for today's video. I hope you guys enjoyed this one. And if you did, make sure you leave a like and let me know your thoughts down in the comment section below. If you're new around here and you want to join the team, make sure you hit that subscribe button and also hit that notification bell so you don't miss out on any of the videos coming out in the future. But I hope you guys have a great day, and I'll see you in the next one.